Hey Bim, what's up guys? Nick Masunda here, video number 23. I'm going to be talking about how much life insurance someone should get in this video. Why should you listen to me? I've been working in financial services for about 7 years, so I just want to help impart some of that knowledge on whoever's watching to help them make better decisions about their own finances. So I'm going to talk about a few different approaches to figuring out a life insurance cover amount in this video. I'll start off from simple and move through to more complex, more detailed. I actually used to work for TAL, which is the largest life insurer in Australia, a subsidiary of TAL, and provide general advice about life insurance to clients day in and day out. So inevitably I'd get asked, how much life insurance should I take out? Ironically, because of the model of the particular company I was working for, I couldn't tell them exactly how much. It was a general advice model, but I was able to tell them how people generally approached this problem, which is basically what I'm going to do today. Talk about some of the approaches that I shared with those clients. So before I get into that, just want to quickly explain what life insurance is and why someone would take out life insurance. So it's a insurance policy that pays out a lump sum if you pass away. Okay. Now, usually people will take out life insurance during the accumulation phase of their life when they're trying to build up their assets, pay off their mortgage, raise their children. If all those things have been achieved, the need for life insurance is significantly diminished. Typically people wouldn't need it because their children are financially independent, they've paid off their house, they've got their nest egg, they're ready to retire, etc. So it's typically for prematurely passing away during that accumulation phase. So that risk of dying before you can pay for the upbringing of your children and pay off the mortgage that your family living in, that risk you are offloading to an insurer at a cost. Okay, that's the basic idea of life insurance. Now, how much should you take out is obviously the question we're addressing in this video. So the first approach, it's a very straightforward approach. It's basically taking a multiple of your annual income. Okay, the idea here being, if your family relies on your income every year and you're worried that when you pass away your income is going to stop and they will no longer have it, then you can say, oh, well, I want my family to be covered for, let's say, 10 years. If I pass away, 10 years of my income. So what would you do? You would take out a benefit amount of 10 times your annual income. Okay, this is just a general rule of thumb. That multiple could be 15, 5. It's going to be bigger if you're younger typically. It's going to be smaller if you're older. All right, because assumedly your children are older, more of your debt's paid off, etc. So that's the very simple approach of just taking a multiple of your annual income. Then you can go and get quotes and see how the cost looks, if that's within your budget, and tweak that cover amount to make sure it's within the budget. So that's the first approach. So it's based on your income. The other two approaches that I'm going to talk about are more based around modeling your expenses. So this second approach, people will look at, okay, what are the major expenses that need to be paid off if I were to pass away early? So like I mentioned earlier, cost for raising children, mortgage on the family home. If I die, I want my family to still be able to remain living in the family home, and I want to make sure the costs of raising the children are covered for my partner. Okay, this approach particularly makes sense if you're like the main breadwinner for the family. Okay, so now you're obviously going to have to get an estimate for cost of raising children. That's going to vary from family to family, lifestyle to lifestyle. The cost of paying off the mortgage is obvious. It's the whatever's outstanding on that mortgage. So you'd add that together and you end up with a benefit amount. So for example, say you owe $500,000 on the mortgage, you've got a child and you've estimated that it's going to cost $200,000 to raise that child to financial independence. So you simply add that together, 500 plus 200, that's a $700,000 life insurance benefit. Okay, so that's a model that's based on your expenses. The third approach is a similar approach in the sense that you're modeling expenses, but it's called a needs analysis. So needs analysis is usually done by advisors, financial advisors, insurance advisors that provide personal advice to their clients. Where in this approach, they're going to get an itemized list of your expenses and extrapolate this into the future, to a certain point in the future. Typically, it's going to be retirement age, right? And the idea here is they want to extrapolate all those expenses up to retirement age, add it all up, okay, and that's going to give you a net amount of expenses up to retirement age. Then they'll get your liquid assets and offset that against it. So if you've got any shares that you're willing to sell or any cash or whatever, they'll offset that against those expenses. And the gap that's not covered is the gap that needs to be offloaded onto the insurer. That's the benefit or the cover amount of the life insurance policy in this example with the needs analysis. So that's probably not something that the average person is going to try and attempt to do at home, but if you do engage an advisor, they'll probably use that approach to figure out how much insurance you should take on. Okay, so they're pretty much the three approaches that I wanted to talk about. So you've got that multiple of income approach, you've got the major expenses, cost of raising children, cost of paying off a mortgage, and you've got the needs analysis where they extrapolate each individual expense into the future to typically retirement age. And they're all going to give you a slightly different number, varying levels of accuracy, and probably all have their own pros and cons. But that gives you a little bit of an insight and hopefully a little bit of an idea as to how to go about calculating at least a rough benefit amount for yourself. So hopefully that was helpful. And that's pretty much all I wanted to cover. So thanks for watching.